A very good evening, students. So, welcome to the session number 1 of chapter number 6, input tax credit. In the last class, we have completed chapter number 5, that is time and value of supply. Now, time for the chapter number 6, input tax credit. Everyone, start in a fresh page, put the main heading, input tax credit. Chapter number 6. Input tax credit. Right. Sir, what is input tax credit? The first question comes to our mind. Sir, are we listening to this word input tax credit for the first time, or we already listened to it? The answer is yes. We have already learned what is input tax credit in the first chapter itself. GST in India, an introduction. So in the first chapter itself, we have learned about input tax credit, and let me rewind it again. Let us discuss the concept of input tax credit with a small example, right? Example, Mr. X, a manufacturer, sir, he purchased raw materials. Worth rupees 10 lakhs, on which he paid IGST. Paid at the rate of 18%, which comes out to be 1.8 lakhs. 1.8 lakhs. Right, sir. Now, with the help of these raw materials, he produced finished goods. Worth rupees 15 lakhs. Right. Now he's selling these finished goods in the open market and he's collecting IGST. So IGST collected at the rate of 18%. How much it comes to? Calculator, everyone, take the calculators. So 15 lakhs into 18%. If you calculate, you will get, sir, 2.7 lakhs, 2,70,000. So IGST collected 2,70,000. Now, while calculating the net GST liability of this manufacturer, so calculation of net GST payable. So IGST collected by selling the finished goods, 2,70,000. So now whatever the IGST collected, now whether the manufacturer is subject to remit the entire amount of 2,70,000 to central government, answer is no, not required. Right? There is no need of remittance of entire 2,70,000 to the central government, because at the time of purchase of the raw materials, he already paid 1,80,000 IGST. This is what we call input IGST paid. So at the time of purchase of the input goods, or at the time of purchase of the capital goods, or at the time of receipt of input services, whatever the taxes we have paid, that taxes is what we call the input taxes. And such input taxes you can take them as credit from the output taxes collected, and taking the credit of input taxes from the output tax is what we call input tax credit, is what we call input tax credit. Now in this example, we need to pay 2,70,000 to the central government, but we have already paid 1,80,000 earlier. So that 1,80,000 retained with you. So that is what we call input tax credit minus input tax credit of IGST paid already. Input tax credit of IGST paid 1,80,000 you have paid already. Take that amount as credit. So net IGST payable, net IGST payable 90,000 rupees. Net IGST payable 90,000 rupees. Clear, sir? So earlier, whatever the input IGST we have paid 1,80,000, that 1,80,000 here we are taking credit, and that is what we call input tax credit. So from this example, you can write the meaning of input tax credit. You can write the meaning of input tax credit. Meaning of input tax credit. Input tax credit is nothing but input tax credit is nothing but taking the credit of input taxes paid from output taxes collected, from the output taxes collected, from the output taxes collected, taking the credit of input taxes paid from the output taxes collected. That is what we call input tax credit. So whatever the earlier taxes we have paid to the government, that taxes we are retaining with ourselves, then only the remaining balance we will pay to the government. Sir, a reason for the allowing of input tax credit, right? Why should the ITC allowed? Why? What is the reason behind allowing the input tax credit? You might have already know this. Why should the input tax credit allowed? The answer is for eliminating the cascading effect of taxes. For eliminating cascading effect of taxes. For eliminating the cascading effect of taxes. So why we are allowing input tax credit? See, if we are not allowing input tax credit, what the supplier will do, whatever the input taxes paid by him, he will simply add back to the cost of the products. So that means whenever he is adding that input taxes to the cost of the product is again going to be taxed at the time of sales. So it means taxes on taxes comes into the picture. Taxes on taxes comes into the picture. And because of that, what is happening? Cascading effect of taxes comes into picture. Because of the cascading effects of taxes, what's happening? The burden on consumer will increases, selling price will increases, and which will ultimately leads to what? Which ultimately leads to the inflation. So you can write next ill effects of cascading effect of taxation. Ill effects of ill effects of cascading cascading effect of taxes ill effects of cascading effect of taxes. It is like tax burden on consumer increases due to double taxation. Tax burden on consumer increases due to double taxation. Due to double taxation, and which will ultimately leads to rise in prices, then which is ultimately leads to increase in the inflation. Increase in the inflation. Right, sir. These are the ill effects of cascading effect of taxes. So for eliminating these all ill effects, we are allowing the input tax credit. So whenever the supplier, the taxpayer getting the input tax credit, right, he will not add the input taxes to the cost of the goods. And when input taxes are not added to the cost of the goods, there is no scope for cascading effect of taxes. So when there is no cascading effect of taxes, so the tax burden on consumer decreases, and the prices, there will be no rise in prices. The prices comparatively reduces, and there is a reduction in the inflation as well. If you remember, you have in the first chapter itself, let me take you to the first chapter where I have explained you the concept of double taxation with the help of example. So this is all the first chapter running notes. If you remember, this is first chapter running notes. Yeah, this is example where we have learned the concept of input tax credit, position under the sales tax system, right? So here you can observe manufacturer, wholesaler, retailer, consumer. We have taken example. Cost of the raw materials, add conversion cost, then sales tax, invoice value. So here at manufacturer level, the invoice value comes out to be 110 rupees. And then wholesaler in his books of account while recording, he will record at 110 rupees. Right, sir. Then at his level, at his stage, conversion cost 50 rupees, totally 160. And add back sales tax at the rate of 10%, 16 rupees, totally 176 will be the invoice value. So you can see at the wholesaler level, right? So on 160 rupees, he is levying the sales tax at the rate of 10%. So 116 to 10% comes out to be 16 rupees. So in this 160, 150 is a cost element and 10 rupees is a tax element. On 10 rupees, again, we are levying tax. So tax on tax. At the retailer stage also, again, same thing, tax on tax. So now because of this, look at the ultimate selling price to the consumer, 260 rupees. And we have written here already in the first chapter itself, major drawbacks under the sales tax system, cascading effect of taxes, tax on tax, double taxation, burden on consumer increases and rise in prices, which ultimately leads to what? Inflation. So that is why we have come up with a concept called VAT, value added tax, at the state level, and at the central level, SENVAT. So SENVAT was introduced in the year 1986 at the central level, and at state level, we have introduced the concept called VAT in the year 2005. Right, sir? So here you can see manufacturer level, cost of the raw material 60, conversion cost 40 rupees, totally 100. Add VAT at the rate of 10%, 10 rupees, totally 110. And when it comes to the wholesaler level, he won't record the value of the goods received, purchased as 110 rupees. He will record at 100 rupees only. Though he paid 110 to the manufacturer, but in his books of account, he will record at only 100. Because whatever the 10 rupees he paid to the manufacturer in the form of input tax, he will get it back in the form of input tax credit. Since he's getting back the taxes paid earlier, he will not add the same to the cost of the product. So when input taxes are not adding to the cost of the products, there is no concept of cascading effect of taxes. So that means successfully cascading effect of taxes eliminated. Right, sir? So you can see in the entire transaction between the manufacturer to wholesaler, wholesaler to the retailer, retailer to the consumer, there is no concept of cascading effect of taxes. No double taxation at any stage. So thereby you can see the burden on consumer decreases, burden on consumer decreases, and there is no rise in prices. In fact, the prices are reduced. Earlier you can see the selling price to the consumer 260 rupees, and now the selling price to the consumer 231 rupees. So drastically reduced to the tune of 29 rupees. Under sales tax system, selling price to the consumer 260. Under the VAT system, selling price to the consumer 231. So 29 rupees reduced, no rise in prices, ultimately no inflation. So inflation will also be reduced to a great extent. These are all the advantages we are getting because of allowing the input tax credit. Clear, sir? So that we have already learned in the first chapter itself. So you can see input tax credit is equal to nothing but taking the credit of input tax from output taxes collected. Advantages: elimination of cascading effect of taxes by allowing the input tax credit across the supply chain, no double taxation, burden on consumer reduced, and reduction in prices. Reduction in prices. So about the input tax credit, we have already learned in the first chapter itself. Clear, sir? Everyone. So look at the introduction part. So generally input tax credit will be given to avoid cascading effect of taxes. To avoid the cascading effect of taxes. Earlier, state VAT taxes will be governed by the respective state laws, and the input tax credit cannot be availed by an interstate dealer who purchases the goods within the state and sells them outside the state. That is, credit chain mechanism don't allow the input tax credit with respect to VAT levied goods, right? Don't allow the input tax credit with respect to VAT levied goods against central levied goods. So that means non-integration of state taxes with central taxes. If you remember, we have also learned this point. Non-integration, the major reasons behind the introduction of GST. This concept we have studied again in the first chapter itself. The major reason is non-integration of central taxes with state taxes. Right, sir? Let me take you to that running notes again. Yeah, here need for GST we have studied in the first chapter. Need for GST, the major drawback in the existing tax structure is non-integration of central taxes with state taxes. Non-integration of central taxes with state taxes. This we have learned with the examples as well. For a manufacturer, at the manufacturer stage, there is no cascading effect of taxes, because whatever the taxes paid by the manufacturer, he will get it back everything in the form of input tax credit. Whatever the excess duty paid by him, he will get it as input tax credit. Whatever the service tax paid by him, he will get it as input tax credit. Olden days we used to call SENVAT credit. SENVAT credit. Whatever the VAT paid by him, he will get it as input tax credit. So at the manufacturer stage, there is no cascading effect of taxes. But at the traders stage, at the service provider stage, there will be a cascading effect of taxes. Because for the traders, only the VAT element is eligible for input tax credit. Neither the excess duty nor the service tax are allowed to be input tax credit. So whatever the excess duties and service taxes paid by the trader, since he is not getting input tax credit, what he used to do, he will add it to the cost of the products. By adding to the cost of the product, what's happening, sir? Cascading effect of taxes. Are you following now? This example, look at here. The same example we have already learned in the first chapter itself. Mr. Y, wholesaler, he purchased the goods from manufacturer and he recorded the price at 11 lakhs rupees. Look at here, 11 lakhs rupees. This 11 lakhs is including excess duty of 1 lakh. You can see here 10 lakhs is the original cost and 1 lakh is the excess duty. And why he added excess duty to the cost of the product? Because excess duty allowed as SENVAT credit only to manufacturer. Once the goods crosses the manufacturer's stage, excess duty not allowed as credit to anyone else. Right? So for wholesaler, excess duty not allowed as credit. So he will simply add it to the cost of the product. When a particular tax added to the cost of the product, there comes double taxation. Cascading effect of taxes comes into the picture. In the similar lines, for a service provider, for a service provider, you know, only the service tax element, only the excise duty element eligible for credit, but VAT not eligible for credit, right? You can see here, excise duty paid eligible for SENVAT credit for service provider, service tax paid eligible for input tax credit, input VAT paid not eligible for input tax credit. So what the service provider will do? The service provider will add that input VAT to his cost of provision of services. And because of that, what will happen? Cascading effect of taxes comes into picture. So these are all the major drawbacks under the existing taxation regime. Central taxes not integrated with state taxes. Right. Their implementation is piecemeal and fragmented. So that is why we have come up with a central tax, one nation, one tax, a united taxation structure across the India. That is the main reason why we have introduced GST, goods and services tax. Okay, sir. So the same point reiterated here. But after the introduction of GST legislature allows seamless credit on goods and services across the entire supply chain in the taxable territory. So chapter 5 of the CGST Act, that is section 16 to 21, and chapter 5 of input tax credit of the CGST rules, that is rule number 36 to 45, prescribes the provisions relating to input tax credit. So section 16 to 21 and rule number 36 to 45 discussed about the provisions of input tax credit. Okay, now, right. So look at some important points here. GST law does not require one-to-one correlation between the input services, input goods, and final product or services. So any eligible input tax credit can be used for the payment of tax of any taxable output supply. So that means, let us assume that, let me tell you with the help of example. Sir, we have purchased input goods A for the manufacturing of finished goods A. Right, sir. Now, at the time of purchasing of this input goods A, we have paid input tax of input GST of rupees 10 lakhs. Input GST of rupees 10 lakhs. Now, this input GST of rupees 10 lakhs, you can be utilized for the payment of output taxes of finished goods A. Also, you can be utilized for the payment of any other output tax liability of you. Suppose that you got output GST liability of rupees 8 lakhs by selling the finished goods B, by selling the finished goods C, by selling the finished goods D. Now this input GST of rupees 10 lakhs, you can use for the payment of any of these output taxes, for the payment of any of these output taxes. No, sir, this input goods A I have utilized only in the manufacturing of finished goods A. So therefore, I should utilize this input tax credit of 10 lakhs only for the output tax liability of finished goods A. No requirement. No one-to-one relationship. Any input tax credit, you can be used for any output tax liability. Are you following, sir? So input goods A credit should be utilized only for finished goods A liability. Input tax B credit should be utilized only for finished goods B liability. Input tax credit of C should be utilized only for the finished goods C liability. No requirement. Any input tax credit, you can be used for any output tax liability. Are you following, sir? Next. Since input tax credit can be availed for the payment of tax on taxable output supply, as a natural corollary, input tax credit is not available when the tax is not payable on output supply, that is on exempted supply. So that means, see, let us take an example, one more example. Sir, I have purchased raw material X and input GST paid rupees 5 lakhs. Now with this raw material X, I am producing A, finished goods A, which is an exempted good, Now, whatever the input GST paid, rupees 5 lakhs on purchase of the raw material X, this input GST of rupees 5 lakhs not eligible for credit. Not eligible for credit. Why, sir? Why? Because you have utilized that input goods exclusively in the manufacturing of exempted goods. Sir, if you're not allowing me input tax credit, I will add to the cost of the goods. Whatever the input tax I paid 5 lakhs, I will add back to the cost of the goods. Okay, you can add, absolutely no problem. Sir, if I add, cascading effect of taxes comes into picture. How? How? Your output goods are exempted? No, right? There is no concept of cascading effect of taxes. Cascading effect of taxes comes into the picture only when your input goods and output goods both are taxable. When your output goods are not taxable, there is no concept of cascading effect of taxes, even if you add input tax to your cost of the goods. Let us see, continuing the same example. Sir, finished goods A, the cost of production, let us say 8 lakhs rupees, add input tax paid at the time of purchase of raw materials. How much input tax paid? 5 lakhs. You can add back to cost of the product, absolutely no problem. 13 lakhs. 13 lakhs. Add your profit margin. Let us say 2 lakhs. So totally 15 lakhs for which you are selling the product. Add output GST. Nil, because your output product, your finished goods A is an exempted good, right? So there will be no output GST liability. So the invoice value you can show in your books of account, the invoice value 15 lakhs rupees. Now you tell me, is there any cascading effect of taxes in this transaction? Though you have added your input tax credit, input taxes paid on purchase of the raw materials, though you have added to your cost of production, there is no cascading effect of taxes in this transaction because your output GST liability is zero, because your output good, that is finished goods A, is an exempted good. So as long as your output goods, as long as your output services are exempted from GST, you are not eligible for input tax credits. You're not eligible for input tax credit. So whatever the input taxes you have paid for producing the exempted goods or for the provision of the exempted services, such input taxes are not eligible for credit. Clear, sir? So that is an important point you have to learn from this example. Next, the exceptions to the above principle is zero rated supply. So for this principle, this is an exception. Zero rated supply. That is exports or supplies to a special economic zone developer or unit where ITC is available even if no tax payable on output supply. Even if no tax is payable on output supply. Sir, zero rated supplies. If you remember, we have already learned about the zero rated supplies in the earlier chapters. Exempted goods definition lo manam chadukunnamamma. Exempted goods definition lo. Nil rated goods are different. Zero rated goods are different. Nil rated goods are exempted goods. ITC not allowed. But zero rated goods are taxable supplies. Taxable at 0%. Input tax credit is allowed. The differences between the nil rated supplies and zero rated supplies we have already learned, right? So let me write it once again. So differences between nil rated supplies and zero rated supplies. So nil rated supplies, zero rated supplies, so nil rated supplies, these are covered under exempted category, and zero rated supplies covered under taxable category. Taxable category. Rate of tax column showing nil, and here rate of tax column showing 0%. Rate of tax column showing 0%. Next, input taxes paid. Input taxes paid not allowed as credit, not allowable as credit. Here, input taxes paid, eligible for credit, So this is the differences between nil rated supplies and zero rated supplies. So zero rated supplies, examples you have take exports and supplies to the sales developers, sales units located in the sales areas. Here you can take the examples as well. Export supplies, and supplies to sales developers and sales units. Okay, ma. Right? See, we need to encourage the exports. Right? So because our products will become, globally marketable, right? And by exporting the goods, we will get the foreign currency reserves, right? Globally, our products become globally competitive, globally recognized, and more and more industrialists will come forward and will start doing the businesses. Thereby, unemployment rate will get reduced. Many of the youth will get the employments, right? Our forex reserves will increase. There are so many benefits. So that's why we should encourage the exports. So that means for the purpose of encouragement, we should not levy any GST. Right, sir? Sir, in that scenario, we can directly cover them under exempted category. No. Why zero rated category? The reason is, if we covered under the exempted category, they are not eligible for input tax credit. They become ineligible for input tax credit. So that is why we have covered them under zero rated supplies. So their output goods are taxable, but taxable at 0%. Since their output goods are taxable, whatever the input taxes paid by them are eligible for input tax credit. So that's the main reason, sir. That's the main reason. Are you following, sir? Alane supplies to the sales developers and supplies to the units located in the sales, right? So they are also eligible for input tax credit as their outward supplies are covered under the zero rated supplies category. Okay, sir. Next, such input tax credit can be used either for the payment of tax on supplies made with tax, or they can also claim a refund. Refund of the same can be obtained. This simple mechanism is used to make the export and supplies to cess completely tax-free. Generally, you will get a doubt here. Such since their outward supplies are taxable at 0%. So that means they are not going to collect any amount from the customer because taxable at 0%. Customer దగ్గర నుంచి ఎలాంటి అవుట్పుట్ జిఎస్టీ కలెక్ట్ చేయరమ్మ వాళ్ళు. So then you will get a doubt, sir, without collecting any amount from the customer in the form of output taxes, how can they claim input taxes as credit? See, suppose if I collected 10 rupees from the customer, from this 10 rupees, I have paid input tax earlier 5 rupees. This 5 rupees I can adjust, I can retain with myself. The remaining 5 rupees I will pay to the department. But if I collected 0 from customer, how can I take the input tax credit of 5 rupees, which I've already paid to the department? Because I collected nothing from customer, right? నేనేం కలెక్ట్ చేయట్లా కస్టమర్ దగ్గర నుంచి, బట్ నేను ఆల్రెడీ పే చేసిన ఇన్పుట్ ట్యాక్సెస్ పరిస్థితి ఏంటి సార్? మరి దాన్ని ఎలా క్రెడిట్ తీసుకోవాలి? హౌ కెన్ ఐ క్లెయిమ్ ద క్రెడిట్ ఆఫ్ ఇన్పుట్ ట్యాక్సెస్ విచ్ ఐ హావ్ ఆల్రెడీ పెయిడ్? Simple answer, sir. Right? If you have any output taxes, from that output tax you can claim input tax credit. If you don't have any output taxes, don't worry. Whatever the input taxes you have paid already, periodically you can claim refund. For every 3 months, file a refund application and get it back. Clear? Next, definitions. So the terms which we are going to use in this particular chapter. So we have some definitions, sir. Let us see. Conveyance, it includes a vessel, an aircraft, and a vehicle. So conveyance means it includes a vessels, ships, specially designed for the transportation of the goods and as well as transportation of passengers, aircrafts, and also a vehicle. Next, definition of inputs, input services, capital goods. So goods, we have two different types, capital goods and input goods. Look at the definition of capital goods. Capital goods means goods value of which is capitalized in the books of account of the person claiming input tax credit, which are used or intended to be used in the courts or in furtherance of business. So whatever the goods we purchase and its value is capitalized in our books of account. So we purchase that goods for what purposes? For the purpose of using or intended to be used in our business. Sir, I purchased a car and I'm using for my personal purpose. Now, can I claim that car as my capital goods? Answer is no, you cannot. You purchased a capital good, but it should not be treated as a capital good since you are using for your personal purposes. Sir, I purchased a truck which I've used in my business for the transportation of the goods. Now, can I call the truck as a capital good? Answer is yes, you can. I purchased a computer and installed in my home. I'm using for my personal purposes. It's not a capital good. I purchased a laptop and I'm using for my office purposes. Can I claim it as a capital good? Yes. Right? So two conditions should be satisfied. Number one, its value should be capitalized in the books of account. And number two, it should be used or intended to be used in your business, in the course or in furtherance of your business. So that is what we call capital goods. Number two, input goods means goods other than capital goods. So other than capital goods, whatever the goods you find in your business, whatever the goods you are using in your business, all such goods are called as input goods. All such goods are called as input goods. Are you following, sir? క్యాపిటల్ గూడ్స్ కాకుండా ఇంకా మీ బిజినెస్ ప్రమిసెస్ లో మీరు ఏవైతే గూడ్స్ ని ఫైండ్ అవుట్ చేస్తున్నారో అవన్నీ ఇన్పుట్ గూడ్స్ అమ్మా. క్లియర్? నెక్స్ట్, సర్వీసెస్. Input services means the services which are used or intended to be used in the course or in furtherance of business. See, input services means the services which we have received. Output services means the services which we provided. If we are receiving a service, it is an input service. If we are providing a service, it is an output service. Clear? Next, input tax credit means taking the credit of input tax, that we have already learned. And after that, you have a definition of motor vehicle. Motor vehicle means any mechanically propelled vehicle adapted for use upon the roads and includes, we have a list of inclusions, a chassis, to which a body has not been attached, and a trailer. A chassis to which a body has not been attached. So that means only the front part of the vehicle will be there. Let us take, see, if you look at a truck, let me use my drawing skills. So it is a truck, right? See here, this front part of the, this is the front part of the body, right? So only the back part of the body is not attached to that, vehicle, right? Only the front part of the body is there, and back part left idle, left empty. So then we call it as a chassis. See, this back part will be designed and manufactured according to the needs of the customers. Like some of the customers requires open top, some of the customers requires fully closed back side of the vehicle, fully closed, and some of the customers requires only the side parts, right? Only the side parts protection, and the remaining portion will be open top. And some of the customers requires it is completely empty, idle, right? So that is why the large truck manufacturers, like example Ashok Leyland, they will first manufacture only the chassis, right? And the body will be manufactured according to the customer's needs, So that is why even a chassis for which a body has not been attached, even that chassis should also be covered in the definition of motor vehicle. And it is also includes a trailer. Okay, sir. Let me show you some images regarding the same. So this is what we call a chassis, right? So you can see here a chassis for which the body has not been attached. Right? So you can see the upper part of the body has not been attached. You can see in the diagrams as well here, types of the chassis frame, right? So the body was not attached to this chassis, but still we can cover this chassis into the definition of motor vehicles. Okay, ma? Next. So it also includes, you can see, it also includes a trailer. So what do you mean by the trailer then? Let me take you there. These are the images for the trailers. You can see this is a semi-trailer, open trailer truck, a semi-trailer truck, puller trucks. These are the examples, right? So you can see here, these are the semi-trailer trucks, vector vehicles, right? So even these also cover into the definition of our motor vehicles. Okay, sir. Now let's go to the definition of the vehicle. So these are the inclusions. Any mechanically propelled vehicle adapted for use upon the roads. So what are the vehicles you can observe on the roads, all covered under the motor vehicles definition? Includes a chassis to which a body has not been attached. Even a chassis also covered under the definition of motor vehicle. It also includes a trailer, but does not include. So now we are coming to the list of exclusions. Does not include a vehicle running upon fixed rails, right? A vehicle running upon fixed rails. So what do you mean by it? Let me take you to that images again. So these are some examples regarding the vehicles running upon the fixed rails. Nothing but majorly you can take the examples of trains, whatever the form it is, like monorail, metro rail, normal goods trains, right? Here even some vehicle you can see, observe a truck running on railway tracks, right? So even that is also covered here. So whatever the vehicles which are running upon the fixed rails, not covered under the definition of motor vehicles, it covered under the exclusions part. And next, a special type vehicle adapted for use only in a factory or in any other enclosed premises, or a vehicle having less than 4 wheels fitted with engine capacity not exceeding 25 cc. A special type vehicle adapted for use only in a factory. See, there are some vehicles you might have observed in factories, which are used to transport the goods from one place in the factory to another place in the factory. Let me show you some images as well regarding the same. So this is some example for the vehicles which are exclusively used in the factory premises. You can see this example, this particular good vehicle. This kind of vehicle you can observe only in the factory premises, sir. Only in the factory premises. And these vehicles you cannot find in the common roads, right? So even the small trucks which are exclusively used in the factory premises. These are all some examples. These vehicles which are used only in the factory premises, only in the factory premises. You don't find these vehicles in the normal roads. So under the definition of the motor vehicles, the vehicles which are exclusively used well within the factory premises for design to transport the goods not covered in the definition of motor vehicles. Right, you can see one more vehicle image here. Yes, this is another vehicle. This you can find only in the factory premises. Okay, sir. So as per the definition of the motor vehicle, it includes any mechanically propelled vehicle adapted for use upon the roads, number one, right? And also includes a chassis to which the body has been not attached and a trailer. Exclusions list చూడండి. Number one, vehicle running upon fixed rails. Number two, special type vehicle adapted for use only in the factory or enclosed premises. And number three, a vehicle having less than 4 wheels. You can take some auto rickshaws where you can find only 3 wheels with the engine capacity not exceeding 25 cc. So this is the definition of the motor vehicle. Okay, sir. And after that, you can see the definition of the principal. Principal means a person on whose behalf the agent carries on the business of supply of the goods or receipt of the goods or services or both. Taxable supply means which is leviable to tax. A supply of the goods or services are both leviable to tax, right? They are called as taxable supplies. Next, eligibility and input tax credit conditions. Conditions for taking the input tax credit, right? So eligibility for taking the input tax credit. Section 16(1) deals with the eligibility criteria. Section 16 subsection 1 deals with eligibility criteria. For the purpose of availment of the input tax credit, the following points shall be considered. First of all, what do you mean by input tax? So input tax means tax payable under forward charge mechanism, right? That is CGST, SGST, UTGST, IGST. Sir, that means tax payable under reverse charge mechanism not covered under input tax. Wait. So majorly input tax means whatever the taxes you have paid under forward charge mechanism, but also includes IGST leviable on import of goods, also includes tax payable under reverse charge. See, whether you are paying the tax under forward charge mechanism or reverse charge mechanism, doesn't matter. It covers under the definition of input goods, input taxes. It covers in the definition of the input taxes. Are you following, sir? So any CGST, SGST, UTGST, IGST paid under forward charge mechanism also includes any IGST paid in the case of import of the goods, also includes any taxes paid under reverse charge mechanism. All these are comes under input taxes, but excludes, we have one exclusion, excludes composition tax, means tax paid by the composition taxpayer. So when you opted for the composition scheme or optional rate scheme, whatever the taxes paid by you, that tax is not eligible for input tax credit. You have already studied, ma. We have already studied in the chapter number 3, right? Levy of the GST. So chapter number 3, we have studied the composition scheme, and there we have studied the major drawback of the composition scheme is those who opted for composition scheme not eligible for input tax credit. Not only them, only it also includes the people who are buying the goods from composition taxpayers. Even that people also not eligible for input tax credit. So neither the composition taxpayer nor the subsequent buyer eligible for input tax credit. Clear? So whatever the composition tax paid, that's not covered under the definition of input tax. Since it is not an input tax, not eligible for input tax credit. As simple as that. Next, who can avail input tax credit? Only a registered person can avail input tax credit. Only a registered persons. All unregistered persons not eligible for credit. Next, on which a registered person can claim input tax credit. A registered person can claim input tax credit on inward supplies of the goods or services or both. Because on inward supplies only, we will pay input taxes. On inward supplies only, we will pay input taxes. And such input taxes we can avail as input tax credit. Such input taxes we can avail as input tax credit. Okay, ma. Next. What do you mean by an inward supply? What do you mean by an inward supply? So look at the definition of inward supply. Inward supply means receipt of the goods or services or both. Receipt of goods or services or both by purchase, acquisition or any other means with or without consideration. See, inward supplies are nothing but purchase of input goods or purchase of capital goods or receipt of services. That's it. Right? So receipt of the goods, you're receiving the goods, you're receiving services. That receipt is in the form of a purchase or in the form of an acquisition or by any other means. Right? And here the consideration factor may exist or may not. So whether that inward supply for a consideration or not for a consideration, it doesn't matter. That's an inward supply. Right, sir? So whatever the goods you have purchased, whatever the services you have received, whatever the capital goods you have acquired, all these covers under the inward supplies. Right. Next. Can a registered person claim input tax credit on inward supplies not used for his or her or its business? Not used. See, we already learned only the input goods which are used or intended to be used in the course or in furtherance of business. Only such input goods, such input taxes paid eligible for credit. You purchased an input good, but using for your personal purposes. You purchased a capital good, but for using your personal purposes, then input tax credit not allowed. Not allowed. Only when they are used in the course or in furtherance of business, they become eligible for input tax credit. As simple as that. Chundamma. Input tax credit will be available on goods or services or both, which are used or intended to be used in the course or in furtherance of the business. Thus, tax paid on inward supply of the goods or services or both, which are used or intended to be used for non-business purposes, cannot be availed as credit. Right? For non-business purposes, not allowed as credit. Input tax credit will be credited in electronic credit ledger. That's common. Whenever the input taxes you have paid, right, on goods or services which are used in the course or in the furtherance of your business, such input taxes will be credited to your electronic credit ledger. Sir, what do you mean by electronic credit ledger? We already have briefing about the same. After successful registration under GST, there are 3 ledgers will be opened in your account: electronic cash ledger, electronic credit ledger, electronic liability register. Electronic liability register. Are you following, sir, everyone? Electronic credit ledger, electronic cash ledger, electronic liability register. These 3 ledgers will be opened in your account. So electronic credit ledger, all input taxes paid by you will be credited to electronic credit ledger. Clear? Next. Conditions for taking input tax credit. So what are the conditions to be satisfied for taking the input tax credit? Sir, here input tax credit is a benefit to taxpayer. It is a benefit to taxpayer, and so that's why department will imposes a lot of conditions. Only those taxpayers who satisfied that conditions will get input tax credit. Clear? So let us see the conditions one by one. So conditions for taking input tax credit. Section 16 subsection 2 deals with the conditions. So first one, a registered person, the first condition itself here is that the person who would like to avail the input tax credit, he must be a registered person. A registered person can claim the input tax credit on a supply if all of the following four conditions were satisfied. If all, you can see here, all of the following four conditions were satisfied. Number one, any of the following documents shall be in the possession of the registered person claiming the input tax credit. So documentary evidence, condition number one in simple terms, I can say documentary evidence. Documentary evidence. You have to produce a documentary evidence to the department. See, orally by saying that, sir, dear department, I have purchased 10 lakhs worth of goods on which I have paid 1 lakh input tax. So let me claim that 1 lakh input tax as credit. Let me avail that 1 lakh input tax as credit. Then immediately the department will ask you, okay, we believe that you paid 1 lakh as input tax as credit, input taxes at the time of purchasing the input goods, but show me some evidence. Show me some evidence. What is the evidence that you paid 1 lakh input tax at the time of purchase of the input goods? Show me some evidence. So what kind of evidence you have to produce? A documentary evidence. What kind of document I should produce? Look at there. Any of the following documents shall be in the possession of a registered person claiming input tax credit. Okay, you purchased goods from some person, no? Right? Someone must have sold to you, right? Yes, sir. Who sold to you? Sir, Mr. X sold the goods to me. I purchased the goods from Mr. X. My supplier is Mr. X. Okay. Mr. X must have issued some invoice to you, no? Tax invoice. Yes, sir. Issued the tax invoice. And that tax invoice is a documentary evidence. Is a documentary evidence. While Mr. X giving the tax invoice, he will prepare like this: value of the goods supplied 10 lakhs, GST at the rate of 10%. So 1 lakh. So invoice value 11 lakhs. 11 lakhs. So this tax invoice will be your evidence. This tax invoice will be your evidence. You can show this tax invoice as an evidence to the department. Thereby, you can claim input tax credit. So look at the department. You asked for a documentary evidence, no? Look at the tax invoice issued by my supplier, whereby you can find the GST paid 1 lakh rupee. So now let me claim that 1 lakh as credit. Are you following, sir? So what kind of documentary evidence we have to produce is invoice, tax invoice, or a revised invoice, debit note issued by the supplier of the goods or services, or both. Tax invoice or a revised tax invoice. Sir, the concept of revised tax invoice and debit note, I will explain you in the chapter number 8. Right, sir? That's the appropriate place to discuss. It's not the right place to discuss now. A revised tax invoice and debit note, I will explain you in the chapter number 8. Clear? Right? So for the time being, you just remember any tax invoice or revised tax invoice or debit note issued by the supplier, we can produce that as an evidence and we can claim input tax credit. Number 2, in the case of imports, bill of entry or similar document prescribed under the Customs Act. So whenever you're importing the goods, you will pay IGST, and that IGST allowed as credit only by producing the bill of entry as an evidence. Bill of entry is a document, it's a kind of invoice, right? Depends upon the situation, the name will differ, right? If a registered taxable person issuing, it is called as a tax invoice. If a composition taxpayer issuing, it is called as a bill of supply. right? In the case of imports, it is called as a bill of entry. So different names in the different places and different circumstances, right? So in the case of the imports, you happen to pay IGST, and that IGST you can claim input tax credit, but only on producing the bill of entry as an evidence, right? Next, in the case of the reverse charge, invoice issued by the recipient along with the proof of payment of the tax. See, under the reverse charge mechanism, the recipient will pay tax directly to the department. Hence, the recipient will issue the tax invoice. Normal cases, supplier will issue the tax invoice. In the normal cases, supplier will issue the tax invoice. But under reverse charge mechanism, the recipient will issue the tax invoice. So tax invoice issued by the recipient will be the documentary evidence for claiming input tax credit. Next, document issued by the ISD, Input Service Distributor. So generally the concept of the input service distributor you will be having at your CF final level. But anyhow, we have a discussion here, and input service distributor discussion will again comes in chapter number 7 and 8. So I will discuss here. Okay, ma. So who is an input service distributor? Let me explain you with the help of example. So everyone put the heading, sir. Concept of input service distributor. Concept of input service distributor. Let me tell you with the help of an example. So for every business concern, for every business unit, there will be some head office and there will be some branch offices, right? So if we take the example of Reliance Industries, they're having their head office in Mumbai. And they're having the branches across the India and as well as in outside the India as well. But for the simplicity, let me take only 4 branches. Branch number 1, which is there in Hyderabad. Branch number 2, which is there in Bangalore. Branch number 3, Chennai. And branch number 4, Kolkata. So totally they're having 4 branches. Head office is there in Mumbai. Sir, in head office, what are the activities will undertake, will going on? So generally in the head office, only the administrative activities will undertake, sir. Administrative activities will happen. Only the administrative activities. No trading will be happen at the head office. No trading activities will undertake by the head office. No trading activities, only administrative activities. Right, sir. Trading activities will not be happen in the head office. All the trading activities will be happen in the branches. Buying and selling of the goods will be happen in the branches only. Head office lo only administrative activities maatrame jarugutayi. Trading activities jaragavu. Clear, sir. But head office will purchase some input goods. It will purchase some capital goods. It will receive some input services. So head office will have some input tax credits, sir. So total input taxes paid by the head office, let us assume that 10 crores. 10 crores. On receipt of the input goods, on receipt of the input services and purchase of the capital goods, right? Totally they have paid an input tax of 10 crores. See, though the trading activity is not happening in the head office, but still for carrying out the administrative activities, it should have received some input services. First, for construction of a head office building, it requires construction services, architect services, interior decorator services, right? For running out the administrative activities, it needs the services of a chartered accountant, company secretary, yes or no? Legal consultancy services, right? For running the head office, it needs some furniture, it needs some machinery like air conditioners. They use some vehicles in the head office. So on purchase of all these capital goods, all these input goods, on receipt of all their input services, they should have paid some input taxes. Sir, but at the head office level, since no trading activities will be taken place, so that means at the head office level, they don't be having any output tax. And when they are not collecting in any output tax at the head office level, how will they take that input tax as credit? Are you following, sir? Head office level లో ఎలాంటి ట్రేడింగ్ యాక్టివిటీస్ జరగవమ్మా, కాబట్టి వాళ్ళు అవుట్పుట్ ట్యాక్సెస్ ఏమి కలెక్ట్ చేయరు. మరి అవుట్పుట్ ట్యాక్సెస్ ఏం కలెక్ట్ చేయనప్పుడు వాళ్ళు ఆల్రెడీ పే చేసిన ఇన్పుట్ ట్యాక్సెస్ ని క్రెడిట్ ఎలా తీసుకుంటారు? పాసిబుల్ అవుతుందా? See, when there is output taxes, there is a scope for claiming input tax credit. When there is no output taxes collected from customers, there is no scope for taking input tax credit. So that's why what the head office will do is this input tax of 10 crores that will be distributed among all the 4 branches, right? This 10 crores will be distributed among all the 4 branches. So input tax credit from head office. This distribution may be equal or maybe depends upon the requirement of the branches. It can be distributed in any manner, sir. It can be distributed in any manner, right, sir? Like 2.5 crores equally distribution chesindi anukundam, sir. 2.5 crore for each branch. Equal distribution taken place. So total 10 crores input tax credit of head office distributed among the branches. Distributed among the branches. Are you following, sir? Everyone. Let me draw it with a different color for the easy identifying. This 10 crores distributed among all the 4 branches equally. Why the distribution taking place here? Because at head office level, claiming of input tax credit not possible because the head office not having any output tax liability. So that is why the input tax credit of head office distributed among the branches. Now the branches, at branches level, trading activities will be taken place. So branches will collect the output tax from the customers. From the output taxes, this input tax can be allowed as credit, can be claimed as credit. Now what the head office is doing, sir? It is distributing. Distributing what? Input tax. Since it is engaged in the activity of distributing the input taxes, it will be called as an input service distributor. So basically for input service distributors, we can take the examples as all the head offices of businesses and all the administrative offices of the business units. So majorly these people will come under input service distributor category. Now what are the inputs GST distributed among these branches? This distribution should be happened under a document, under the cover of a document. So this head office will issue a document to these branches, and by showing the documentary evidence, these branches can now avail input tax credit, right? See, the department will question you, ma branch 1, you are claiming 2.5 crores as input tax credit. From where you get this input taxes? Branch 1 said, sir, I've got this from my head office, right? My head office is an input service distributor. He distributed me 2.5 crores input tax credit. Is there any documentary evidence for the same? Yes, sir. Look at this document. This document is issued by my head office at the time of distribution of input tax credit. Are you following, sir? So that is the documentary evidence in the case of input service distributor. So any document issued by the ISD. So for claiming of the input tax credit, the registered person should possess any of these documents: a tax invoice, a revised tax invoice, or debit note. In the case of the imports, bill of entry. In the case of reverse charge mechanism, tax invoice issued by the recipient. In the case of ISD, input service distributor, any other document issued by the input service distributor. Clear? Next, the above documents should contain at least the following details. So the documents must have some details, amount of the tax charged, description of the goods or services, total value of the supply of the goods or services or both, GST IN of the supplier and recipient. GST IN is nothing but GST identification number. GST identification number. In simple terms, we call it as a registration number, sir. GST registration number. So that documentary evidence must contain the GST registration of the both supplier and as well as recipient. And place of supply in the case of interstate supply. If the transaction is happen to be an interstate supply, the place of supply should be there. Ante the state to which the goods are destined. What is the destination state? The details must have been there in the documentary evidence. Clear? Next, CGST rules specifies that the original copy of the document is for the recipient of the goods. So generally the invoice will be prepared in triplicate, 3 copies, ma'am. Original copy is for the recipient, duplicate copy for the transporter, and the triplicate copy is lies with the supplier. So original document is always to the recipient, and the recipient should show this original document for claiming of input tax credit. The original copy may preferably be kept record to support the credit entry. Next, input tax credit of tax paid towards the demand involving the fraud. No input tax credit will be available. See, you paid input taxes, sir. You have documentary evidence, but such input taxes you are paid by the demand notice issued by the department. Department found that, right? So you are making some clandestine removal of the goods, some illegal goods you are transporting, or some goods you are transporting or you are selling without issuing any tax invoices, right? Some goods you have purchased but you have not shown in your records. So the department raised a demand notice, issued a demand notice on you. You entered into a fraudulent transactions. As a result, department issued a demand notice on you, and as a reply to the demand notice, you have paid taxes. So now you went to the department and you asked, okay, department, anyhow, I paid input tax, no, at least with respect to a reply to a demand notice. So now let me claim that input tax is paid by me as input tax credit. But department said no, no. See, if you paid the input taxes, right, genuinely, honestly, without indulging yourself into a fraudulent transactions, such input taxes you can claim as credit. But here you have paid the input taxes in a fraudulent manner, right? As a reply to a demand notice. So such input taxes not allowed as credit. Clear? So you can see here, no input tax credit will be available of tax paid towards the demand has been confirmed on account of any fraud, willful misstatement, or suppression of facts. Right, sir? So this is condition number 1. What is condition number 1? Documentary evidence. Now, look at the condition number 2. Receipt of the goods and or services. Receipt of the goods and or services. So that means those persons who would like to claim the input tax credit, they must have received the goods into his premises. So you can see here, the person taking the input tax credit must have received the goods or services into his premises. Let me tell you with the help of an example. So we are in the topic of conditions for claiming input tax credit. Conditions for claiming input tax credit. So look at the example. Second condition we are discussing. So Mr. X is the supplier of the goods. supplied the goods to Mr. Y, recipient of the goods, recipient of the goods. Sir, on 25th of August 2021, the goods movement started, and the goods reached to the recipient premises. Goods reached the recipient premises on 3rd of September 2021. So as and when the goods entered into the recipient premises, as and when the truck entered into the recipient's premises, right, then immediately the recipient can avail input tax credit in his electronic credit ledger account. In his electronic credit ledger account, he can pass a credit entry by input tax credit, let it be 10 lakhs rupees. He can pass a credit entry. See here, you can observe that as and when the goods entered into the recipient's premises, immediately he can avail input tax credit. There is no discussion about the consideration. So irrespective of the fact whether he paid the consideration immediately, whether he is paying to supplier the consideration in installments, it doesn't matter. What ultimately matters is the goods must be entered into the recipient's premises. What ultimately matters. That is what ultimately matters. So whether the recipient paid the consideration to the supplier or not, doesn't matter. Are you following, sir, everyone? Right. So as and when the goods entered into the recipient premises, immediately the recipient can avail input tax credit. Clear, sir? So on 25th, the movement of the goods started. So on 25th, he cannot avail input tax credit because he has not received the input goods into his premises yet. On 3rd of September, yes, goods reached the premises of recipient. On 3rd September, he can avail input tax credit. He can avail input tax credit. So the condition is that recipient must have received the goods into his premises. That's the condition. So do we have any exception? Answer is yes. The exception is bill to ship to model. So this is the original provision. This is the original provision. Original provision. For this original provision, we have an exception. Bill to ship to model. Bill to ship to model. Clear? Now, what is this bill to ship to model? Let me explain you along with the help of example. So the original provision I can write here. For claiming input tax credit, recipient must have received the goods into his premises. This is original provision, but for this original provision, we have an exception. The exception is bill to ship to model. Bill to ship to model. Now, what is this bill to ship to model? Let me explain you with the help of example. Example, Mr. X, a supplier from Hyderabad, right? And Mr. Y, a recipient from Warangal, right? So X and Y both are belonging to the same state, that is the state of Telangana. Supplier is from Hyderabad and recipient is from Warangal. Recipient is from Warangal, right? So Mr. Y purchased the goods from Mr. X. Y purchased the goods from Mr. X. Now what Mr. X has to do? Mr. X has to supply the goods to Mr. Y, right? Now, while the goods are being transported to Mr. Y, that is a recipient, to the Warangal, in the meanwhile, what happened is Mr. Y received a order from Mr. Z. Mr. Z, from Mr. Z, right? Now, Mr. Y sold the same goods to Mr. Z. Now, Mr. Y instructed to Mr. X. So, Mr. X, don't deliver the goods to me, right? I've already sold the goods to Mr. Z. So you can directly deliver the goods to Mr. Z. Now the truck will be rerouted to Z premises, to Z's premises, right? Unnecessarily you deliver the goods to me. Then again, I deliver the goods to Mr. Z, who is there in Hyderabad itself, who is there in Hyderabad itself. So I found a prospective buyer with respect to the same goods. I've already sold the goods to Mr. Z, right? So Mr. X, please kindly deliver the goods in the Z's premises. So accordingly, as per the instructions from Mr. Y, Mr. X delivered the goods in the premises of Mr. Z. Now here you can see there are two transactions. Transaction number one between Mr. X to Mr. Y. Transaction number two between Mr. Y to Mr. Z. There are two transactions. Now here you can see Mr. Y is not received the goods into his premises. While the goods are in movement, the goods are transported to the ultimate buyer, right? Y has not received the goods into his premises, but still Mr. Y can avail input tax credit. So the original provision is recipient must have received the goods into his premises, and the exception is bill to ship to model. Even though in this example, even though Mr. Y has not received the goods into his premises, not received the goods into his premises, still he can avail input tax credit. Still he can avail input tax credit. Still he can avail input tax credit. Are you following, sir? Even though Mr. Y has not received the goods into his premises. See, just because of the reason for satisfying this condition, receiving the goods to Warangal and again sending them to Hyderabad and the judge's premises, it's unnecessary waste of the time, money, and everything. So that's why Mr. Y said directly to Mr. X, Mr. X directly transport the goods to Mr. Z, my ultimate buyer, right? So here the department cannot deny the input tax credit to Mr. Y, showing the reason that you are not received the goods into your premises. He should not, the department should not deny that input tax credit to Mr. Y. Are you following, sir? Right? So this is bill to ship to model. So check it out. So in case if the supply of the goods or services has been made to a third party as per the directions given by the recipient of such supply, then in that case, such recipient shall be deemed to be the recipient of the goods. Therefore, ITC shall be available to the recipient, right? Even the services are also eligible under this model. Example, Chudandama, A is a trader who places an order on B for a consignment of soda ash. A further sells the same to C. Now A instructs B to deliver the goods to C, and in turn he raises an invoice on C. Here A is entitled to input tax credit on the consignment, though the goods are not physically received at the premises of A. Are you following, sir? Right? The example is that you can see A, B, and C. So initially A and B entered into the transaction. Now B is supposed to transport the goods to A. But while the goods are in transit, A already sold the goods to C and given the instructions to B. Now B directly transported the goods in the premises of C. B directly transported the goods in the premises of the C. Now here Mr. A not received the goods into his premises. Not received the goods into his premises. Right, sir. Still, even though he not received the goods into his premises, still he can avail input tax credit. He can avail input tax credit. Are you following, sir? Right. So that's the second condition and its exception. Third condition, tax leviable on supply actually paid to the government. Right. So that means, just a second, sir. I'd like to stop the session here. Right. So I need to attend a meeting now. So I would like to stop the session here. Out of the totally 4 conditions, we have completed 2 conditions, right? 1, the documentary evidence, and 2, receipt of the goods. We have 2 more conditions to discuss for availment of input tax credit. Number 1, tax leviable on supply actually paid to the government, and the last one, filing of returns. These 2 I will discuss in the next session. Right, sir? Next session we will complete this topic. Right. So see you in the next session, sir. Till then, have a good day. Stay home and stay safe.